We had absolute madness last week with the jobs reports, jobs coming in much lower than expected. But the bigger story was the downward revisions from the past few months, down roughly 90%, and the firing of the person in charge of that data. This maybe caused, some will say, a slight Bitcoin correction, but it did hold that 112,000 previous all-time high. We're going to unpack all of this and more, of course, on Macro Monday. Let's go.
Let's go.
Let's jump right into it. It's Macro Monday. We got Mike, James, and Dave. Good morning, gentlemen.
Good morning.
Good morning.
Laser on. We know it means one thing, a lot of press today.
Yeah, usually means stuff's moving. It's what I do here is that being able to talk about markets is like show and tell. I have to admit, I love it because 99% of the time you do the research and try to come up with conclusions. So today I want to talk about crude oil, which is again dropping. And well, I don't, my view has been it's going to continue to drop.
So what do we got from the morning meeting today?
Not too much different. Anna pointed out that ISM services should watch unemployment numbers. She expects that to stabilize. The key thing about the downward revisions from the BLS data is they are bigger than 2008 and 9. And she pointed out the key issue, I think, with this potential firing is a lack of transparency. But by firing the BLS head, it might tilt to the opposite when if the data comes out stronger, people will be somewhat suspect. Michael Casper filled it in for Gina Martin Adams. He's our technical guy in equities. He pointed to the same thing that Gina's been pointing out in terms of the equity market. Their market pulsed index shows manic reading. They did this in March. I think they pointed out, it might have been February, and it just usually means you're going to have underperformance period. And stuff we all know, significant concentration risks. You need only about 50 stocks in S&P 500 to replicate the entire index. Erica Eidenberg came on. She's really our mortgage-backed person. She pointed out how horrible the housing market's looking and getting worse, and OS spreads are widening. But she also reiterated the rate team's view for 10-year note key support in terms of yield and 10-year notes, 419 to 413 area, and they fully expect the Fed to be more aggressive in easing and have a bull steepener continue. I enjoyed some of the comments from Audrey Child-Friedman, our FX strategist, pointing out she still remains cyclically bearish the dollar, pointing at accelerating de-dollarization, which I'll push back a little bit in terms of crypto dollars, but that's something else. And then pointed out how dependent the Swiss economy is on exports and up to 15% of their goods used to be to the U.S. And then I pointed out my key views. One thing, my key conclusion is gold absolutely loves Mr. Trump, particularly versus everything he does. I mean, when a headline hit the tape Friday about firing the BLS director, my first thought was buy more gold. And so I'm getting more and more bullish gold after it's consolidated for 4 to 5 months. I think the next step is it just pops up above 3,500 and goes towards 4,000. I point out virtually all the commodities now are heading lower. The 3 C's, crude oil's heading lower, corn is heading lower, it's harvest, and now copper might be joining that stage. They're all heading towards levels from 2019, and I just overlay that with bond yields in China, 1.71, which is my still indication that with commodities going down, going lower, most of the main ones, bond yields in China going lower, the connection, just a matter of time that U.S. bond yields fall. So I'm sticking with that. And yes, I've been wrong for a couple of years on that one. And then I pointed out to me one of the key leading indicators is still that gold, Bitcoin to gold ratio, which looks like it's peaked and maybe potentially heading back lower. Back to you.
Yeah, I think, James, you wrote about it this weekend. I was not at all surprised this week on the topic that you chose, because it was all the rage, obviously. At the end of the week, we had this stunning revision show U.S. added 258K fewer jobs than first reported. So on this show, we've constantly, I think, berated the BLS for better or for worse for their downward revisions when nobody's looking. We basically erased a year of job numbers recently after the Biden administration. And obviously, knowing that markets react to these job numbers and then they're completely wrong in the end is sort of farcical. But in this case, we had such a shocking revision. Here you go. The U.S. only added 19,000 jobs in May compared to initial report of 144,000, and 14,000 in June after initial report of 147,000. And then in July, we got 70,000 when we expected over 100. So clearly a major softening here in the job market if the numbers are to be believed. But I think the shocker here obviously was the firing of the BLS director as a result of this. Listen, my first reaction was like, if I was 90% off on the data at my job, I'd probably get fired. But, of course, there's the other side, which is that maybe now we can't trust any numbers moving forward because it's political, and Trump and Bassett and all of them have sort of made it political by saying that, these numbers were cooked, not just incompetence, but sort of maliciously changed. And of course, then after we dig into news weather, we can talk about what this means for the Fed, because obviously if job market's exceptionally weak, maybe Powell has covered a cut now. But James, I'm going to go ahead and bring up your newsletter right here. Your inspirational tweet was from the one and only Anna. I still don't know which one, and I asked her to her face, Wong.
Yeah, I mean, it was really confusing because the moment I saw it, I immediately thought, it's got to be the birth and death model. That's your knee-jerk reaction on Wall Street is like, oh, they got the expansion and contraction of companies wrong. So the birth and death model, for people who don't know, is it's an assumption. It's built into the model that kind of estimates how many jobs are either added or removed from the economy because of companies opening up or shutting down. And so often that's the culprit when you have revisions. But in this case, it didn't seem like that. The revisions are, if you go down a little bit, Scott, you can see this chart that Bloomberg put out. Yeah, keep going. Well, that's the amount of revisions we've had, and then just keep going down a little bit further.
461,000 jobs down. Oh, no,
it's crazy, right there. And you see that white line? That's the initial collection rate of surveys, and so they're down about 55-60% of managers responding to these surveys now. And so that's part of the problem, is that you're busy running a business. You're not going to take the government's call to fill out this survey, and it costs money to be at work and do these things. And you're busy focusing on your core business, and people don't want to deal with the nonsense, and that's just reality. This has been going on for years. It's been on the downside. And so how good are the numbers? Well, you're only getting 55 to 60% surveys returned in the first go around. Of course you're going to have revisions. So that's kind of like the big number one. And then the second thing is, there is incompetence in the government. We know it. We've seen it. We've all experienced it. And especially with these assumptions and numbers and the CPI and the PPI and BLS data, it's not something you can rely on, systematically. You've got to take everything kind of with a grain of salt. I mean, even I've written about this, University of Michigan. I mean, this is a consumer sentiment survey, the University of Michigan survey that the world looks at, and it's like 600 or 700 people that they're surveying. It's insane. It's like literally less than a blade of grass. And I made this analogy when I wrote a newsletter about it last year. If you took a football field and the entire football field were blades of grass of people in the United States, the people they surveyed would cover 1 square inch of that entire football field. And then everybody is extrapolating the entire economy and the entire healthy economy and expectations of inflation off of those few hundred people. It's literally insanity. But so just put that aside, and you just know that these surveys are only as good as the data you're getting into them and the models that you're generating with that data. So you've got these models that make all these assumptions. Getting back to what happened this time, Anna Wong, she did point out that it wasn't really the birth and death model. It was more along the lines of assumptions around seasonal factors, kind of things like this part of the year would be school hirings, teachers and that stuff. So they obviously made a lot of assumptions that didn't come true. And then the second part of it was just private jobs. And so They just got it wrong. They made assumptions that were wrong. And that's the problem with this data, is that it comes out with these huge assumptions and they're just wildly off. And so is it incompetence? Well, I mean, the joke has been, as long as I've been alive, that get a government job because you'll never get fired. You can't get fired out of a government job. Well, there's two things that are going on to me politically right now with the Trump administration, which is, number one, they're taking away that stigma. They're saying, or that assumption. They're saying, yes, you can get fired for incompetence, or if you're doing something that's illegal or illicit, you can be fired from your job in the government. That's number one. The second thing is what you just said, Scott, which is, are we moving into full banana republic? Because we've got two, we're bipolar here in our electorate, where we've got two parties who are extremely far apart, and they no longer work together. They just fight each other in every single step. And so are we now going to have these huge swings of millions and millions and millions of people who are fired and hired by different administrations that only massage data or make things appear the way they want them to appear in order to get reelected? Because that, again, is the only driver every 4 years and every 2 years. So,
Dave, what I find complicated here, before you jump in, and I know you should have thoughts on this, is that the claim obviously was that, I'm not saying even by Trump, when we saw the Biden number revision, we all went, holy shit, they've been claiming we had a strong economy this whole time. It was weak, right? Because based on job numbers, now you have the same kind of revisions down, and Trump saying that they're cooking the books for a reason, but actually revisions down are exactly what Trump wants when he's bullying the Fed. Like, Trump should be thrilled about this if his goal is. Yeah, I'm just saying, I'm not even saying like no positive, negative here. I'm just saying that in a vacuum, really shitty job numbers is what Trump wants to bully Powell into the cuts that he's been berating him over.
So you can hold two thoughts in your head at the same time. Both could be accurate. And this is what I can't understand, how basically virtually every Democrat I've seen on this on X or in the media can't hold these two thoughts in their head at the same time, which basically infantilizes them. Thought number one, Trump threw a temper tantrum. Thought number two, the fish stinks from the head down. And when you want to make substantive change, you fire the person who's responsible for the incompetence. And at the end of the day, you can hold those two thoughts in your head. Both are true. And it's simple. The thing about the Michigan thing, all I could think about when James was talking about his blade of grass analogy is the people that they survey for these things, the ratio of the government workers who count the surveys to the people who are being surveyed is absurd. And, when you have processes that were built before computers, you're going to have really bad process. And we have this in so many areas. I mean, I think it was Paul Grewal this morning. I can't remember who, but I think it was Paul from Coinbase talking about the Bank Secrecy Act that was built on paper. Well, Paul Atkins, one of the reasons people loved his speech, which we should talk about last week because it was a big deal, is that he's basically challenging the assumptions of all the financial rules that were built basically before computers. Forget blockchain, built before computers existed, and built things like Reg NMS. People don't know this, but Reg NMS was built literally. That's the foundational. Last time we did stock market structure changes, built specifically because we can't compute that, we don't have enough power, so let's change the rule to deal with what we could actually compute. And yet we assume these things are there. So now you have the Bureau of Labor Statistics and you have the Fed, and between them there are thousands of human beings who are counting this data, and it's absolutely absurd. You could probably get a tenth of the Doge team together to figure out a better way to do this much faster. And the fact that you have political appointees who don't even think along those lines is a problem. Now, did Trump do this because he wanted to make it more efficient and make the economy better? Who the hell knows? Did he have a temper tantrum about it and fire the person in a fit of pique? Yeah, probably. And as I said, two thoughts in your head at the same time. And grown-ups understand this. We people have been constantly saying how the ADP forecast doesn't matter, except it always turns out to matter. right? And so, so we have a private sector version of the forecast that actually is more accurate. But unfortunately, people know that the Fed bases its own decisions based upon backward-looking data after revisions from the BLS and others, as opposed to forward-looking, which is the joke of why the fact the Fed has 20,000 employees and they have 800 some odd PhD statisticians that they completely ignore in their board meetings, because the history of the Fed has been to ignore all the prospective model data and only look backward. And yet we don't care because they're a private company, so they pay for those people, except for we've delegated them power. So the whole thing is a morass. The Bureau of Labor Statistics isn't terribly different.
That we don't pay for the Fed? Yeah, but we are ultimately paying for them because
you and I agree on this. I'm basically trying to give a little bit of rope.
Right. Okay.
For the morons who keep arguing with me about how, oh my God, we need Fed independence. Yeah, that's a mirage they were taught. Just like that mirage is as dumb as the one that says we need inflation in the economy structurally, or people won't spend money and you won't grow, which is absurd. But look, there's many things that people have been, quote, taught. Hell, Scott triggered a thread of morons, on in terms of incentives, saying that, oh no, if you just cap people's earnings at $3 million, that'll be okay, because who needs the difference between 3 million and 50 million?
The guy
Forget that would turn America
that,
into.
yeah.
We would all be heading into Galt's Gulch if you tried to do that right now.
God.
And innovation would literally die. And people, smart seeming people, are morons about this. I mean, really, really dumb, not understanding. I mean, I actually picked out the one person on the planet that I know for a fact wouldn't have created Amazon, because Jeff Bezos, along with my ex-bosses at Two Sigma, used to work at D.E. Shaw, making millions, but not billions, not tens of millions, single-digit millions. They all went out on their own because they thought they could do better. And the world is a better place for it. And so people need to understand that all of this is related. It's all related. Now, there's one thing I do want to talk about that's separate that I'd like to. It won't trigger Mike. It actually is interesting. I watched an interview. Now, I know it was with Tucker Carlson, so okay, forget the interviewer, but the interviewee, Richard Werner, was extraordinarily interesting. I don't know if you follow him, James.
Economist, yeah.
Yeah, but very, very interesting. And he basically said something about this that was really that I'd like to get into. He talked about that QE, basically QE and how that relates and what the central banks want. And he specifically talks about something I always talk about, which is asset inflation versus consumer inflation versus everything else. And so that was interesting last week. And then the other thing that was interesting last week was, Paul Atkins and what all that means. So there's a lot of other stuff. But as far as this temper tantrum / BLS, I mean, the last thing I'll mention on employment data, because the Fred comes out from St. Louis. And people who think that there's no method to the madness are not paying attention. If you create a chart, and I don't know if I can share my screen or not. Let me see if it'll let me. Is that this one? Share screen, and I want not that. No, it's not. It's hold on, window. No, it's not. I can't figure out how to do it.
James and Mike have figured it out.
Yeah, I'll figure it out eventually, because I haven't done it in a while. But I'm just on the Fred site, and if you chart the civilian labor force, foreign-born versus native-born, it's rather remarkable how over the last several months, let's see, 1, 2, 3, when did this start? This was in March. So since March, native-born employment is up significantly when foreign-born employment is down significantly. And so the net of that is that's foreign born. You see how far it's gone down. Now do native born, and you'll see something very different. Now, if you don't realize that is exactly the intent of this administration's policies, you're not paying attention. So remember, they don't really care about the macro stuff now. They care about it going into next year when we get into the midterms. But understand that when you see people like Besant talking about how the economy is moving in the right direction, he's talking about that. And so, in terms of interest rate cuts and, all the other stuff, we could talk about interest rates, also, but it's important to understand there's a lot of factors going on underneath the surface. The other thing that was in the report that was interesting last week, James, I don't know what you thought about this, or Mike, but the average hourly earnings were up, right?
Yeah.
And so, we revised jobs down, most of them from foreign-born, people, but we saw earnings up. Is this bad or good? I mean, this is all going to get spun in a different way. I mean, it's entirely possible that Trump threw the temper tantrum precisely because he wants to fix, he wants efficiency, or people are yelling at him to, or it could just be totally political. Who the hell knows? I mean, we don't know what's going on.
I would love, I mean, I want to know what Mike thinks of whether this firing was political or, if you're off by casual 90% every month.
Well, one thing I think we've reiterated in this conversation so far is the key thing, the strength of the U.S. is people call it our dichotomy, our discourse right now. That's how strong we are because we beat the shit out of each other. And there's such a self-correcting mechanism in this country. It's unstoppable. So some of that data, maybe it's a little bit messed up, but there's so many people like me who are paid to figure it out. And point out the truth of markets versus what you see from the government, and people come from the government to the private sector and back. So I'm very, to me, one of the best data sources on the planet for everything is U.S. government data, partly because we beat the shit out of each other, make sure we get it right, and there's so many third-party sources doing it. So don't underestimate that. I knew that would tee off, I think, Dave and James a little bit, but we know that because we've been in and out of it. And I've had, people I've known have been in and out of government jobs, particularly IRS and things. But I want to just point out a couple charts to kick into the macro a little bit. I think what's happening and show you what's going to matter. To me, it's the next 4 months of this year is going to set the stage for everything. And the bottom line is this line here. This is just the performance this year of the beta, S&P 500. Gold and Bitcoin. If this rolls over, which it looks like it's right now, and if it's down in the year, that's a huge trade that kicks in maybe for years. And that probably is part of the reason why I think gold's figuring out. Gold's particularly going to go higher, and just fully expect Bitcoin to follow this S&P 500 if it rolls over, which is what I think is going to happen. And bottom line, so I'm going to tick into a few charts, and I want to show you why. This is something that never happens. The number one rule I learned in trading options, the board of trade, is volatility is always mean reverting. This is 30-day volatility S&P 500. It's the lowest basically since 2019. It just doesn't stay above that level. We all know right now we're in that period. Okay, we're going to August. We're going to get some volatility. We should see some selling, some hit some bids, some profit taking the stock market. The question is how long it lasts. But for now, this is a key thing to think about today as we get this little bounce. Is this volatility is only going to go up from this level unless it's different this time. And also I overlay it with my favorite ratio, Bitcoin divided by gold. It's still at that same level. It has not been able to break above it. If volatility stock market goes up, Bitcoin gold goes down. So I'll just give you two long-term charts, and I'll stop annoying you with this. This is one I just kicked in just published this weekend. And Dave, you kind of inspired this. It's how do you measure the stock market? Now there's traditional ways versus earnings and multiples and all that. So I just take the S&P 500 versus GDP versus gold versus the rest of the world and versus Bloomberg Commodity Index. And the best leading indicator, stuff that trades daily, is S&P 500 versus gold. I'm going back 50 years. It's rolling over. Okay, maybe that'll stop. Maybe by the end of the year, this will tilt up. Hopefully we'll get lucky. This is the annual chart, but it's tilting downward. To me, that's the key thing. And I'll end with one final chart. Going back 100 years, this is where we are on the stock market versus GDP. And this is where we are on the stock market versus gold. Hopefully by the end of the year, this will turn down and this will keep going up. The risks is this just turns down a little bit. That's what I think we potentially got started with this week.
So much there. Go ahead, Mike.
Well, one of the things that we need to talk about, Mike, is the reaction of the bond market to Friday's numbers. I mean, the two-year moved, and this is all comes into play for what we expect the Fed to do, the interest rate probability, and then also just liquidity going forward, right? So how much liquidity is going to be added to the market because we're getting lower interest rates, and that is a good question. The 2-year move, for people who don't know, it moved like the yield moved over 7% in one day on Friday. Now, it went from what was it went from 399 to it went from 399 down to 370 and change in one day. Something insane. Like these moves are it's almost historic. So it went all the way down. Actually, I apologize. It went all the way down to 368. It closed at 368 on Friday. And so that's a massive move. And that's telling you what that 2 years, what people expect the Fed to be doing. And that's basically what the 2 years telling the Fed where they want rates. So, but if you go to the interest rate probability monitor, and actually I can actually figure out how to bring this up. So hold on a second. I'll show this for you guys. That's a dig on Dave. Sorry, Dave.
It's okay. I figured out why I couldn't. It's because
it was
using the wrong Google login.
Oh, that's a thing. Yeah, I gotcha.
I have two.
So here's the probability monitor, right? So this is on Bloomberg. It shows you right here the number of this is the probability of a rate cut right here in the September meeting. Well, if you go back just 1 week, okay, to the beginning of July, the last week of July, one Monday ago, you have the obviously the July probability monitor in there too, because it was still ahead of that meeting. But here's where it was 67% probability. Well, it got over 90% this weekend, which was interesting. And so you just flash forward 1 week, and here it is at 87% likelihood of a rate cut. So now it looks like you're going to have 2.5 cuts before the end of the year. And that's a pretty big divergence from just a week ago. So you're seeing the bond market react accordingly, and that's and to me, there's a question about whether the bond market can actually force the Fed's hands, and I guess that's what people are wondering. And I'd like to hear Mike's thoughts on this, because that move was pretty historic.
I think that's a great question. I think the answer is absolutely. The number 1 and 2 factors to, if I'm at the Fed and learning the lessons and mistakes they've made in the past, is right now I think the best indications for the next ease is just let the bond market and the stock market tell us what to do, and we'll be just fine. And that's why I think it's just starting to tell them, yeah, okay, you got to start easing. We all know you typically, when it comes to real easing, it typically doesn't come in 25 basis points. It typically comes in 50 and more, and you go really fast from that high plateau to a trough that usually lasts for a long time. That's just the way cycles work. It's like unemployment always going to 6%. And by the way, the 12-month volatility of unemployment is the lowest since 2002. So we're ready for some moves. And what you pointed out is the way usually things work. And the key lessons I've learned trading bonds since I started in the business is it's the most leveraged market on the planet. And for the last few years, people like me who've been trading bonds for almost 4 decades have been wrong. Knock on wood, I've been wrong. And we get stopped out. And then what happens? It usually goes that way so fast. We're like, oh, shoot, I just didn't hold on. Michael Burry, that's what the movie Big Short came about. And some of us were very bearish in stocks in 2006 and bullish bonds. And it just took a while, but finally kicked in. It just took 2 years. To me, that's what's showing now. And I can show you a chart. What's the divergence now is, what you mentioned is the 2-year. This is this 200-day moving average. The 200-day moving average has been rolling over, but it's stuck. Now it's at 4%. It just dropped to 468, the actual 2. It's going to come. We're going to get that ease. We just need a little data. But,
yeah.
Right, 368. Sorry about that. And then you look at the 200-day moving average of the long bond yield. It's completely heading higher. It's still in a bear market for prices. That's at some point, I think, going to come, and when it moves, it'll move fast. And maybe that's what just started. And maybe we'll get lucky, but then you look for catalysts. I've been wrong partly in the last few years, partly because we didn't have an unprecedented catalyst, which like happened with tariffs, and what's what happened with Mr. Trump pushing back on the Fed. And it's the chart I showed earlier about, the highest stock market versus GDP. I wrote about it for a while. It's just timing, nothing against Mr. Trump, but his timing might be as bad as Herbert Hoover's, just based on how elevated equity our markets are. Maybe that's finally kicking in. So my whole scenario, by the end of the year, I might have to throw water on it, but if it kicks in, it means what you're seeing happen yesterday is just getting started. It's done. Summer doldrums. It's so nice to come in and not see markets getting hit hard, because they'll just get stopped out and go back up. But those bond yields are still ticking lower.
I mean, do we think that if the Fed actually cuts in September, that long rates are going to go down?
September's still a long way away. We'll see what happens. See what happens in the stock market. Remember, the key thing about what's happening with volatility here in stock market volatility doesn't go down. I mean, volatility is always mean reverting. It's got to pop up, and this is the time of year. So we've got a lot of time between then. But things can happen suddenly after being so gradual.
Yeah, but let's talk about that, because volatility being so low adds liquidity to the markets, because it means that prime brokers, banks, they're requiring lower collateral for borrowing, which means that there's just more liquidity. So you got to remember that. That's just something to keep in the back of your mind. I kind of agree, Mike. I think that the reality is the market can push the Fed to make a move in the short term. So short-term rates can move. The question of long-term rates really comes down to, do we have some sort of credit event? I mean, what would drive the long end to go lower? Well, you'd have to have a major hiccup in the market, right? So that would be a flight to safety for people. Play. Yeah, people go. Yeah. You'd have investors go flight to safety to the 10-year, and number one, and number two, the expectation of much lower rates in the future because of a hiccup. And so,
can I ask you guys a question?
Yeah,
because I haven't looked at it and I don't know, but what is the consensus projection for nominal GDP growth over the next 2 to 10 years? Nominal, not inflation adjusted.
That's a good question.
Now, the reason I ask this is because one of the things that Richard Werner was talking about is how the U.S. has faster nominal growing GDP, and that our bond yields, our bond yields tend to track nominal GDP growth estimates or projections pretty damn well. And so the answer to your question of why are these things here is answered that way. And he also had a really interesting, there was a lot of talking about regional banks, and there was a lot of interesting stuff in there. But the other thing that he talked about is China. The reason their banking system exploded as much as it was is that his predecessor went to Japan and talked to the Japanese about how did they engineer their growth miracle, and their growth miracle was from local, massive expansion in local banking to support local small businesses all throughout the country. And so that's why China has so many banks. And that has very interesting implications given stable coins. Also, it's another thread to pull on. But so that was just a question while you're looking that up. Now, the one thing I will say about volatility, you talk about it. S&P volatility is definitely cyclical. We know that. And when markets stall out like they have in the summer, and you can look at it, it's just very small. That's not unusual. The seasonality of volatility is real. In the absence of like a major August, surprise, like the problem with the data series is they're very outliery. So we had a massive event in 2015. We've had events, but absent events, the summer volatility is generally low. It generally picks up into September, October. We've all heard on this channel me saying multiple times that there's obviously a crash risk in the fall, because of these low volatility numbers, and because of the fact that the stock market is priced to perfection. I'm not saying it's going to happen. I'm saying it could happen. I would say if it doesn't happen, then Bitcoin's going to explode higher in the fourth quarter. If it does happen, then everything, gold included, will go down, when people throw what they have to, and then things will sort out afterwards. But it's because if you start comparing Bitcoin volatility and saying it's low because of the S&P volatility, you are literally not paying attention. Bitcoin's volatility has been dropping ever since the ETFs came in, and that's not surprising. I was interested you didn't talk about that with Jim Bianco, who completely got that 100% wrong. You could have called him on it. It would have been rather amusing. He probably would have been unhappy about that, because he said a lot of really interesting, good things. But he got that one so wrong that I almost.
The reason Dave needs a show is so that you can do the gotchas and argue with people.
Well, no.
I just like to get people's opinion on what they think. And
no, it's not that. You got a lot of really good stuff. One of the things he did say that's worth saying, it's maybe worth it, is he explained in the history of the Federal Reserve how the chair gets to what they want. And that was a
Back to
really interesting anecdote
I'd
that he
never heard
talked
that
about.
actually. I'd
Yeah,
never
I
heard
hadn't
that.
either. I thought,
Yeah.
as I said, wealth of information. He got Bitcoin ETFs wrong in what it would do completely. I mean, and I said it right when he said it, so
Yeah.
you know, I'll take a victory lap on that one. But what he talked about the Fed was fascinating. What he said is that historically, ever since the Federal Reserve voted to cut rates against Volcker, and Volcker immediately tendered his resignation, which then forced the board to say, we don't want you to resign, so we won't cut rates. Ever since then, the board has done what the chair has wanted. And that is an extremely important fact that I didn't know, and explains a lot about why the political pressure is pushing so hard. It also explains why 2 dissents on the board is so meaningful, because dissents generally don't happen. One
Not
maybe,
generally, they
but
just don't. They just don't happen. Yeah.
so understanding what's going on here is interesting. And let's contextualize this. You know, whether you believe the BLS at 2.7% inflation or Trueflation at 1.7 or whatever it is, the Fed funds rates being, you know, significantly above that is, forget accommodative. I mean, a neutral Fed funds rate
way
would be
above neutral. Yeah.
neutral would be somewhere between 2.5 and 3.
Right.
And we're well above that right now, which is why it's funny how people say, oh well, look, long bond will go up. If the long bond goes up because of cutting now, given everything that's going on, it could. But if it does, it's because people just don't want our paper. And you know, and there's a financing trade going on that ceases. The carry trade unwind is the thing that people are most worried about.
Let's go back
with cutting.
Yeah.
Let me just
Go back to the Fed for a second. And
I was trying to pick to point
so
poke Mike
the
there,
issue
so.
here is that the Fed and Powell keep saying this over and over again. We've talked about it before. He keeps hammering the pounding the table. They are data dependent. They're data dependent. They're data dependent. They're data dependent. Well, they're depending on data that is severely lagging and obviously flawed. And so those are 2 bad things. So the Fed is lagging the lag, which is, you know, that's not good. And then the second thing is, at the same time, they keep talking about tariffs and the possibility and the probability of inflation caused by tariffs. And he did footnote it this last time. Powell did footnote it by saying it would just be a one-time impact to pricing, you know, likely. And they're trying to figure that out, which would be the what they were looking for in the last go around with inflation, which it wasn't. But they, you know, the issue here is that they're using this data as a crutch, but they're so far behind on it that what if it is just transitional, you know? And like, what if it actually is? And what if it doesn't have as much impact as everybody expects it to? The issue here is that you've got the Fed that's bumbling back and forth, and you don't know exactly what everybody in the Fed is thinking because of what Dave just said. Having 2 dissents is massive, but what was that meeting like? Can we get the minutes from it and listen to it? You know, I mean, like that would be pretty interesting to me. But that's why you've got these economists who are fumbling around and they've got wildly different views on what's going to happen for the rest of the year. I mean, let me just read you 2 quotes then. And Mike, I want to hear what you have to say, but just 2 quotes for you to just chew on. So according to Morgan Stanley strategist Michael Wilson, investors should buy into any sell-off because of the robust earnings outlook. And he and his colleagues wrote that we're buyers of pullbacks and bullish for the next 12 months. Okay, so frame that there. And then in an article that is literally right below that, you've got Wells Fargo quoted as the U.S. economy is struggling to maintain its footing, said Sarah House, a senior economist at Wells Fargo. Businesses and consumers have been facing a whirlwind of economic policy changes, elevated inflation, and monetary policy that remains somewhat restrictive. The loss of momentum feared by this mix is unfortunately beginning to bear out. So which way is it? Like that's why it's so confusing for all the investors out there, because you've got this data that's going back and forth. We don't know which data is actually accurate, number one. And we also don't know which data the Fed is going to depend on. And then, and those two things put together is what's causing so much uncertainty, in my opinion.
So the data that we have that's accurate, it's sometimes I think worthless, and to hear what people think about markets is prices. And we have the most expensive stock market, as I showed you earlier, in about 100 years by many measures. Okay, there's your sentiment. We all know what happens in those environments. You suck human nature in. You can't go down until it goes down. Everybody's got to keep up. We're at that stage, and that's why it's the number one thing I think the Fed missed in 2021 when they should have started hiking rates, when the stock market started breaking out new highs, and they kept cutting, kept them easy. No stock. I think in the future we're going to look at that lesson from Einstein. Is the questions are the same, the answers have changed. You got to be watching the stock market a little more, and they all know you don't add fuel to the punch bowl, alcohol to the punch bowl in this environment. They're just not saying it, but we know it. It's just kind of silly. You create a bigger spike and then it goes down later. But I want to address some of those key questions. First of all, with what Dave said, let's just go back. I just pulled up our Bloomberg economics estimates for GDP. And I can show you this. Right now, GDP, it's been running 1.5%. Now, this is in reverse 2028, run 1% or so 2026, and expected maybe bump up to 2%.
Well, that's not nominal, is it, Mike?
I know, I get it. I get it. It's not nominal. I don't know how to find it. I just want to keep out the key. It sparked the key question I've had in crude oil and economics for most of this year. When is the last time you've heard an upward estimate, in not only just a year now, but certainly since Trump's been elected, upward estimate? It's all about demand estimate reversions. That's the lesson I learned like day one in trading bits. What do the estimate revisions do? When's the last time you heard an upward revision in the demand for, or GDP going up, crude oil going up? Haven't heard it, all heading lower, or supply estimate revisions continue to go up. That's the key thing in terms of crude oil and economics. It's the key thing I wanted to point out that also matters. And also you mentioned volatility, Bitcoin volatility. Spot on. I remember writing about this in 2017 where futures were long. So that's the beginning of Bitcoin volatility going towards the level of gold. So right now, annual volatility and Bitcoin volatility versus gold, at 2.2x gold is the lowest ever. Now that's an annual measure. Okay, you can use shorter term measures, but we'll just keep it simple. It's the lowest ever. It's going to continue lower. Bitcoin at some point, I've always said, is at some point it's digital gold. It just is very highly correlated to the stock market. It's getting there. It's that transition phase. And it's one thing that we all know is if transition without bumps in the road is a problem. And that's what I've been pointing out is despite the fact this average since Bitcoin reached that same level it is right now versus gold in 2021, despite the fact it traded over that period over 3 times the volatility gold, it's still the same performance. So for now, if you're running money and you're running leverage, you are pointing out facts of, sorry, this asset's great, everybody loves it, which usually means for a typical money manager who's somewhat contrarian says, okay, if everybody loves it, what should I do? And if it's underperforming this stupid rock, that's a problem. My point is it's 4 years now, it's still underperforming and the volatility is declining. So I think that's going to continue, but that's where I'm looking at. Right now, it's a short-term trade. We all know the stock market needs to correct a little bit. We all know at some point the Fed needs to ease. It's what happens by the end of this year that's going to really matter and flip a lot of things. And as I look on the screens, they're hitting crude oil, they're hitting corn, bond yields have a problem. This is just early days. And by the way, it's August. Most people are not on the trading desk yet.
So the one I hate going and having to repeat myself week after week after week, and I think our viewers are tired of it. But ignoring the fact that Bitcoin's hash network just hit an all-time high, that every adoption metric is hitting an all-time high, that the market just literally absorbed, you know, an enormous trade. And I did the comparison, comparing the 80,000 Bitcoin compared to the 50,000 the Germans did. So when the German government sold Bitcoin, it dropped 17% in terms of impact, and the sale itself was done somewhere around 13% below where it was trading before they started actually selling. In the trade that happened this summer, it dropped 3%, and the trade was sold almost directly in line with the market with virtually no cost. At least not it was in basis points, not in that. I actually have written a whole paper about this. I'm waiting for the firm's compliance department to approve it. But the fact is that this is a big deal. And so we know that there's a lot of change, and you know, you could go on Bitbo and do the Bitcoin volatility chart, and you can see historically, you know, how it's smoothed out and where things are going. Bitcoin's volatility is down, but every single time you mention Bitcoin versus gold and you say talk about it, you're comparing it. You're starting your index at the froth of 2021, when I will tell you that the ratio of price to the hash rate itself was now 7 times higher than it is today.
And it's not higher. That sucks. I'm just pointing out poor performance of a highly volatile risk.
I'm telling you, there's no euphoria. You're indexing. Yeah, thank you.
Yeah, obviously don't read the headlines. Every headline I have of crypto people is going to millions, just come on, Dave. What's the froth in the massive buying of Bitcoin ETFs? Come on, there's massive. This is the most speculative
slow and
in the
steady
crypto
accumulation.
Oh, okay.
We had outflows though, Mike. We did have some outflows. Finally,
a little bit of profit taking. That's good. I'm glad there's some responsible people taking some profits.
And by the way, when you talk about crypto versus Bitcoin, there's a very, very big difference. I mean, Scott had a really good, very succinct, post on this one.
Wait, just to double check. Ask your question. Isn't Bitcoin a crypto? Wasn't the first in 2009? Isn't there 19 million now?
Currency. Everything else are assets that are empowered by blockchain technology.
So it's not powered by blockchain technology?
Of course it is. It is.
Okay.
That's like saying that's like basically comparing Kodak, US Steel, Amazon, and I don't know, some utility company, and say, well, they're all equities. They should all behave the same.
I didn't say behave the same. There's unlimited supply of cryptocurrencies. Bitcoin's
There's unlimited supply of equities.
Exactly.
There's unlimited supply of everything. The issue is
equities can go private, and they do. And they go under, and
cryptos could be turned into zombies. In fact,
trust me, I've got about 2,000 of them in my portfolio.
I'd love to see. I'd love to see signs of the Bloomberg Galaxy Crypto Index outperforming the stock market or gold, and I've seen the opposite. I'm pointing out facts of underperformance in an asset that's pumped up a lot, and I think is somewhat peaked with the stock market. It's not that complicated, and Bitcoin's is one of them.
Yeah, well, okay. I mean, we could go down this rabbit hole and argue it, but honestly, we've reached the point where it doesn't matter. The case for Bitcoin is very, very different. I mean, I'm not Max Kaiser saying every altcoin goes to zero versus Bitcoin. He also thinks real estate's going to zero against Bitcoin, which I don't really understand, but okay. But what I am saying is that the fundamentals under Bitcoin are that we can see observable, trackable fundamentals are very different. And when you cherry pick a time when the market was way ahead of itself as your index date, you get different answers.
Oh, I got to push back on it. It's not cherry picking. It's picking where the market is now and where it's the first time it reached that level. And what does that mean? It's not, you can call it all you want, but the people who are running real leverage money now are finding out I'm taking an inordinate amount of risk and leverage for a poor performance for 4 years now. Yes, it was great when it was at 10,000. Michael Saylor discovered his business model wasn't doing so well, so he went over to Bitcoin. Now we have a lot of people whose businesses aren't doing so great, so they're rolling over to Bitcoin. You know how this is going to play out in history, Dave. I'm looking to write about it. Maybe it's different this time. That's why I pointed about.
It's not different. You're talking about adoption. It's never changed since we first started talking. Since the day I met you. The sole question is, will Bitcoin gain a critical mass of adoption? Yes or no? Will it become digital gold? Yes or no? That question has not been answered yet. When the answer to that question will derive its future price action in $2025, right? Or in whatever date you start to base it for. Will Bitcoin, because I fully expect gold to continue to rise, and I expect that every time as gold rises, that just rises the target for me in terms of where Bitcoin goes. And the question of whether it will reach that adoption is assuming a fact, not an evidence. We don't know the answer yet. I personally think the answer will be yes. You personally think the answer will be no. I get that. That's totally
no. I agree on the big picture. Remember, one thing that we have to remember what's happening here is this is a revolutionary technology, and it's kicking the whole world. As Jim Bianco pointed out, that we had how many currencies did we have 20 years ago? Now we have fewer and fewer. The world is going to the dollar via this technology of tokenization. It's amazing, but it's proving the headline of Satoshi Nakamoto's peer-to-peer cash from Bitcoin. White paper is wrong. I wrote about that years ago. It's not peer-to-peer cash. It's digital gold. It's just very expensive with a high correlation in the stock market. Historically, very high correlation in the stock market. Historically, gold has a negative correlation in the stock market. And we're at the stage where the stock market is the most expensive in some measures in history. And I point out, by the end of the year, if I've been wrong on this view, I will eat it and move on and get stopped out. But for now, I still see gold up almost 30%, Bitcoin running 20% with the stock market up 7%. My point is, if that stock market tilts down to unchanged on the year, we're going to see Bitcoin be a nail to hammer as all those people in buying saying, uh-oh, I have to do what I did in 2006 and 7 and 8 and 1999 because it's happening again. That's the risk. Maybe by then year, we'll be fine. That's the key thing now. It looks like it's tilting that way. Now, I'm a commodity guy. I look at things that's happening. Gold going up and crude oil going down is a bad sign. Gold going from 4 years of outflows of ETFs now to significant inflows means maybe that rock's going to keep winning.
Here's what I think our listeners want to understand. All things being equal, if the Fed lowers rates, okay, all things being equal, and then you get some more economic data, whatever. September comes along, we're just kind of plunking along here. You come out of the summer doldrums of July and August, you get into September, the market's just kind of bumping around, grinding sideways. What happens to the stock market? What happens to gold? What happens to Bitcoin? If the Fed starts lowering rates in September, without there being any sort of negative event, no black swans, no credit events, it's just, okay, it's time to start lowering rates. What do you think happens?
So we're at the stage now. Happens a few times in history. The stock market is the economy. It's 2 times GDP. Obviously, I'm somewhat jaded. I started in the business covering Japanese customers.
I agree. We are completely financialized.
It is the economy. So that's the point. Is the Fed will use, I think, partly when the stock market tells them if they make that mistake again, maybe, but Trump's pushing them that way. And then we have all this pressure on corporate earnings from tariffs.
All things being equal, though, Mike, I think that they're going to lower. They're going to lower.
We agree. But what's the key force to make them lower is risk assets going down. What happened on Friday?
Yeah, but what if they lower without risk assets going down? That's my point. What if we're just grinding sideways, and it looks like the unemployment's continue to tick up, and the jobs numbers are not great, and we do get the truflation reality of inflation kind of easing here under 2%. That would be amazing. But like what I mean, that's the risk of the other side of your trade, is that that's the risk of your trade. The other side is this just continues to grind sideways. We get Fed to lower rates, liquidity expands, and we're back off to the races. And whether you want to call it a crack up boom, or it's just a continuation of an expansion of GDP nominally, Dave, and money supply, however you want to put it.
So
there's your risk.
It's just missing the lessons of cycle and lessons of price of time by Edward Chancellor that we are having real time seeing this right now. PPI, the latest PPI in China is minus 3.6%, yet they're pushing up their M2 at double what's happening in US right now. This is happening in China. In Japan. A lot of us have lived through that and seen it before. That's my key point is virtually every cycle of significant inflation on the back of massive liquidity pump always is followed by deflation. Now I'm seeing that clearly in gold and commodities. We're seeing it clearly in China and the rest of the world now. ECB is probably going to cut rates this week, partly because they have to. They see what's happening. It's the tilt in the cycle heading downward, and hopefully you'll be able to write in my book. It was different. We got to 2 times GDP and we stayed there, or we stayed higher. That would be wonderful. But I'm fearful just going to do what normally has happened in history and just kind of revert a little bit. The valuation of U.S. risk assets, which means
the fundamental problem, the fundamental distinction between us is James and I do not argue with you on valuation of streams of forward cash flows and earnings from companies having to be tied to GDP. We don't argue about that. We do, however, completely disagree with you that Bitcoins, whose fundamental value proposition is will it or won't it become digital gold and beyond, that has anything to do with GDP, fluctuations. In fact, our base case, at least mine, is that a severe correction in GDP caused by unwinding of monetary excess will actually promote its adoption even further once the initial shock is over. So that is a distinction. That's not a distinction without a difference. Now, you think that correlations are causation in this, that can't happen, but that's literally what we're talking about. And that is a knife edge thing. And yes, we've reached stasis on this. We don't meet, which is, we've reached the point where there's no argument. We're not going to convince you, and we'll just have to let it play out. But understand that's the core argument here. James, am I phrasing this reasonably?
Yeah.
Well, can I just ask one question? Do you think Bitcoin's done with 50, 60, 70% corrections?
No,
I don't think
No, but
anything
I
is
think-
done with anything. I
Yeah.
think it is. Look,
I think
if
Okay,
it's
there
so
is
maybe
a
I'm being more tactical.
hyperinflationary
Maybe I'm being more
collapse-
tactical. I just think in an environment
No,
like this,
I
you don't want to buy the
answer your
highly
question
volatile risk
fairly.
asset.
You asked me a question, Mike.
Yeah.
I think that all other things being equal, absent a Great Depression style market crash event, the answer to your question is yes. But you have to asterisk it. If you get a situation where people are jumping out of buildings and markets are dropping 25% in a day, and no one knows what the value of collateral is, and everything is being sold to raise cash, then sure, you could see massive corrections. But
So basically, the
outside
answer
of
is no. You
that-
don't expect a 50%, 60%
No, I
correction.
don't. I
okay,
think
so
I
that's-
think volatility. I think the chart Scott showed before is exactly what I expect.
So
I
let's
think
keep this simple.
a 20% correction is totally rational.
Let's just keep
I
this
mean, we
simple.
just had an over 30%. We did 30%.
We'll just keep it simple. I have loved getting very bullish Bitcoin when people told me it's going to zero, and I've enjoyed getting bearish Bitcoin when people said it's done correcting. We're similar in a stage right now. The vast majority of people I talk to who are way overweight and long Bitcoin says, "Oh, we're not going to see any more of those corrections." I've seen it every time. In 2006, did you think the housing market wasn't going to drop when there's a consensus? In 2006, 7 or so, were you one of those people who were bullish commodities because they always have inverted to the stock market? I'm not saying you, but it's just the way these are things I've heard.
Let
me just pull up one chart, Scott. Pull up the chart that I just shared. Europe is lowering rates. Look at where their inflation is. It's above the target. It's been above the target. It remains above the target. It grinds above the target. So now what have they done? Without admitting it, they've basically said, well, we're gonna say it's within a range that we're comfortable
raise the target.
with.
Yeah, move
They've
the target.
raised the target. It's no longer a target. It's a range now. They're like, it's close enough. We're lowering rates. This is the lesson that they're not learning. This is the reality of what the world we live in. It demands expansion of liquidity and debt, and it will forever. And that's the issue that that brings two problems. The problem is, number one, we've seen the expansion of the money supply and liquidity drive asset prices higher, which drives the stock market higher, which drives consumer prices higher. It's all interrelated, right? But it also means that we are susceptible to a crash, like you're talking about, Mike, because of the leverage in the system. And in both those situations, over the long term, over the long haul, I want to own Bitcoin.
I would pose Mike's question a different way, because in the past we get the big drawdowns, but then we get even more multiples to the upside of other markets. So what if we pose the question, do you expect Bitcoin to have 500% rises in raging bull markets again in the future?
Well, if you look at the lessons of what's happening with a adulting market, volatility in Bitcoin's collapsing versus gold and most other assets, as it gets into the mainstream, it's adulting. The best performance of Bitcoin, those days are over.
Yeah. Well, I think, we'll see. I personally think, and just so we're clear, I said that we flipped the old trading range is now a newer, more compressed trading range between 112 and 122. We bounced almost textbook perfectly off the bottom of that trading range, and we'll see what happens. But the longer it goes like this, we'll see. I suspect that the rally, based upon the growing understanding around the world of just how fucked up our monetary policies are globally, is the driver of Bitcoin's perception of value. Yeah. And that's different than the driver of NVIDIA's perception of value.
And the driver of its adoption.
That's what I mean. And so those are the metrics that matter. Everything else is noise. And yeah, you're right. I mean, there's correlation, etc. But it really is that. And the more I tweeted last week something about, when you see people talk about Banana Republic stuff, it's not Banana Republic stuff. Banana Republic stuff, you want to know the ultimate one is the what Kash Patel has been finding in the FBI about the Obama administration agreeing with Hillary to spread Russia collusion to stop a president from taking office. That's Banana Republic stuff. So let's be really clear about it. You know, throwing a temper tantrum because you see incompetent organization and taking it out on them, that's reality TV stuff. He did that on The Apprentice. He's doing it now. That should be no surprise to anybody. But what's true is all of this stuff, the central banking stuff, the notion that QE is a mainstream tool is the kind of reason why Bitcoin has adoption. It is an opt-out in a sense. It's really a measuring stick. And we'll see. I mean, look, we don't know. It may not. It may not gain that critical mass. I mean, certainly the administration wants it to do better, but do they want it to gain that critical mass? I'm not so sure about that. They want the dollar. They want treasury yields to be.
So what's their view on gold, the administration? I'm being facetious.
They tolerate it. It's the same. It's been the same.
Exactly.
Greenspan,
Okay, so that's
Powell, Bernanke, Yellen, all basically, they've all looked at gold and they're all okay as long as it doesn't rise parabolically. If it rises parabolically, they're very.
But they're happy if Bitcoin and cryptos do.
It's not about Bitcoin is a toy right now. If Bitcoin was at gold, if Bitcoin was at $1 million, and which would basically put it pari passu with gold, and people were talking about a parabolic rise from there, yeah, they'd be terrified. For the same reason, they don't want to see a parabolic rise. They don't want gold to have a parabolic rise. They don't.
So I have to just point out the lessons of markets, and Benjamin Disraeli, former UK Prime Minister, what we generally expect does not occur. That's the biggest problem I have with Bitcoin. I just sense the pile on trade going way too high, and I'm just showing, okay, is it worthy? Yeah, it should be showing that outperformance. And I'm, well, great. Okay, it's good you have the views. Look at the price. It's near record high. Doesn't matter. It's what price tells everything. And then I look at gold. Yeah, it's near record high, but it's been flat for 4 months. And I just see this stupid rock still outperforming stocks and Bitcoin this year. And hopefully McGlone will be wrong. But by the end of the year, if these, let's say it continues, that's going to gain more and more momentum that way towards gold and away from the highly speculative digital asset that has 19 million similar type cryptocurrencies.
I don't know what happened while we were on this show as we conclude here. Bitcoin, as you said, Dave, right off 112, which is that high. And
it's
50,
a technical move.
I know I'm saying, but gold also up, stocks also up, and Bitcoin dominance down. So you look, Solana actually ripping, Ethereum ripping more than Bitcoin. So we have one of those everything up Monday mornings.
Well, we can talk about it in 10 minutes.
That's right. See you guys on Spaces. Guys, amazing show as always. We will, of course, be back next Monday for another Macro Monday. Mike, good luck talking oil with people less argumentative than us.
No, our discourse is awesome. I much appreciate it. It helps hone views. So thank you for that.
Absolutely the best. Thank you, gentlemen. See you next week.
That's dope.